Sweet.
Morning, guys.
Good morning.
What's up?
How we doing? Happy sip day.
Doing
Yeah, I
great.
did not shave for you today, and I did not do my hair tucker, but I'm on vacation calling in for the sip this week. So happy to talk to you guys from the beach.
Man, that background looks way better than ours. Actually, mine's backwards. Let me fix it. There we go. Now mine's better. But all right, guys. So I think we're going to talk about the difference in ETFs and mutual funds. We use those obviously so much every day in all the trading that we do, building client portfolios, all that stuff. But I feel like too a lot of people they just sound like very similar investments with different ticker symbols,
Yeah.
but they're structured differently, right? So I don't know, Nav, do you kind of want to kick us off with,
Yeah,
kind of the difference? I think you have a chart for it, maybe.
absolutely. Yeah. And I'll share my screen just to give a highlight of some of the key differences between what mutual fund is and what an ETF is. But let's start with a quick similarity, and it's both are pool investments that pull together different, uh, whether it's stock, bond, alternative investments, whatever it may be, into one fund so that an investor can get broad access to a sector, index, and investment style without having to go and buy each and every one of those positions themselves. Simple one would be the S&P 500. If you buy a mutual fund or ETF that tracks that index, you're getting all those stocks in that one index instead of you going out and buying 500 different stocks. Um, but what are some of the key differences? Mutual funds are priced once daily, and that's after market close, so you don't get that intraday pricing. While ETFs trades more like a stock, so you do get that intraday pricing and real time price discovery. Management style, both can be active or managed. At one point, ETFs were mostly passive. Now there's a lot of ETFs that are coming out that are actively managed. So this often active versus typically passive is not as big as it used to be. Um, Fees, mutual funds, there's a lot of different styles of mutual funds, A shares, C shares, investor class, I shares. So there's a bunch of different terms that comes with the mutual funds that can include sales loads or higher expense ratios. So that's why that comes in with fees, and ETFs are usually lower cost because they're lower fees because they don't have those types of classes. But now we see a lot of the mutual funds and ETFs are pretty close in price, depending on if it's an index or passive investment versus active. Um, the big one is this tax efficiency, especially for when you're investing in a taxable investment account, brokerage account. Um, Mutual funds tend to be less tax efficient due to capital gains distributions over exchange traded funds. Main reason is exchange traded funds can actually create new share classes and new exchanges, so they don't need to sell to redeem investments. Unlike a mutual fund, which can't create new shares, and they actually have to send the money. They have to sell shares in order to send money to investors who are redeeming, and that creates, when you sell and buy, creates a capital gain loss depending on what the um, side is, and then that actually forces capital gains out of the market or out of the fund, and that can create tax inefficiency. And then there's a few others underneath with transparency, liquidity, and minimum investments. But I want to kick it off to Joe to talk a little bit more about that mutual fund side of things.
Yeah, can you stop sharing?
Yep.
So that screen was heavy for ETFs, and I think the market has really shown that of this new structure, or relatively new exchange traded funds, is pulling in more money than mutual funds. But that chart nav you have was entirely, I would say, favored towards ETFs. There are some benefits to mutual funds. You know what the example I had when you were thinking of when you showed intraday trading, that's true. Like you can buy the ETFs throughout the day, where mutual funds, you're not trading them over an exchange, you're buying and redeeming them from a fund company, right? Or buying from a fund company. And what I thought of was my Snyder's of Hanover pretzels. My favorite snack are those hot buffalo wings, Snyder's of Hanover pretzels. So naturally, you'd be like, well, you should probably have them in your cabinet, right? If you like them. But if I have them in my cabinet, I'm gonna eat the whole bag. Like it's not good for me to have those nearby because I'm going to eat them all. So the ability to trade intraday in ETFs is not necessarily a good thing, right? To be able to do that. And there's a lot of studies that we've seen of investors actually do better when there's like a restriction on them accessing their money. So it sort of seems counterintuitive, like, hey, we want access to our money and control, but having that sometimes can be detrimental. Another example of that is performance history. So we'll use a lot of mutual funds with clients because we'll really like a strategy or um, a process that a fund has, and maybe they've been doing it for 35 years or 20 years or a long time and has consistent track record. Versus we'll see a new ETF that kind of just started, last spring, so it doesn't have the performance history on that, like a mutual fund might. And then finally, sometimes we see for like systematic purchases. So if you're making $100 a month purchases, $1,000 a month purchases, a mutual fund can be a better structure, like from an operational standpoint to do dollar cost averaging or similar. So like now all your points were true, and I agreed with all of them. But I was like, man, this chart was like made by an ETF provider of everything on there. So the market's speaking though, right? Like my opinion, your opinion, Tucker's opinion, we all have them, but ultimately the market decides. And what this shows is ETFs picking up market share. So let's talk about the different axes on here. So on the y-axis, we have inflows or outflows. So money going in or money going out of these different types of investment vehicles. And then on the x-axis, we have years. So going back to 2013 each year. So for instance, in 2013, passive ETFs had 183 billion of inflows. Active mutual funds had 152 billion of inflows. So positive numbers here. And Nav, you mentioned this earlier, active ETFs becoming a bigger thing because there's barely any inflows in 2013 because it just was a relatively new market for them. But what you've seen over this 10-year period of time is year over year, passive ETFs have had positive inflows and really increasing over time, especially here kind of post-COVID. We see a huge jump here in passive ETFs. So where is that coming from? Well, it's coming from cash entering the marketplace. And then also you're seeing a big negative in active mutual funds. I mean, extremely so in 2022, the amount of outflows that we saw that year. So over a 10-year period, this is about $4.5 trillion going into ETFs and about nearly a trillion coming out of mutual funds. So the market is speaking in the sense of mutual funds are still a larger percentage of the overall investment marketplace for that, but ETFs are certainly generating more inflows. And you're going to see mutual funds stay there a long time because a lot of this is not so simple as, well, I'm going to move to a mutual fund from a mutual fund to an ETF because maybe you've owned that fund for 25 years and you have significant capital gains in that fund. So to switch from A to B, there may be tax consequences to do so. So you're going to see mutual funds because they're kind of the, on the inside track, so to speak. They have more assets than ETFs, even though it's kind of clear which way the market is positioning it.
Yeah, well said. And
Yeah.
Tucker, what do we miss?
I mean, I definitely agree. I think Nav's illustration there was definitely very ETF centric, and I mean, it a lot of the I mean, it all makes sense. Those are great points and everything too, and I think one of the useful things as well with mutual funds, kind of going to what Joe said about how the restrictions can kind of help people, which sounds weird in the trading aspect, but with mutual funds, you're also allowed to trade to like the exact dollar amount that you want as well. So I think, not by a huge margin, but it can really allow a more quote unquote precise asset allocation too, if you really want to boil it down. But no, I think that in that chart you had, Joe, was really interesting too about the inflows and outflows of the different funds. I mean, you just got to look at the charts, see what the markets are saying, but I think the mutual funds are probably going to stick around for a while, obviously, because they have so many assets already built up in them, and in
Right.
order to get out of those, it's not an easy thing to do.
Yeah, that's right. And I think there's a misnomer that I hear a lot from clients where they'll say something like, "Oh yeah, I want like an index fund, like an ETF." And it's like having an ETF does not necessarily mean it's a passive or index fund investment, nor does having a mutual fund mean that it's not an index, right? You can have a mutual fund that's a passive mutual fund that's tracking an index. But I don't know, Nav or Tucker, if you guys hear that, but I hear that frequently if somebody will say, oh, yeah, I'm in index funds like ETFs. And it's like, well, that might be true, but we have to see exactly what the ETFs are and what the mutual funds are, because you could have a lower cost lineup of mutual funds than ETFs, depending on what the strategy is in each of the components.
Yeah,
Exactly.
for sure.
And I don't see that as often as I used to hear that. Uh,
Yep.
Clients are definitely more educated, but that chart is telling from the active mutual fund side of the redemptions happening, which goes back to that tax portion of that's another reason why it's been kind of exaggerated the last 3 years because we've had a lot of redemptions out of those active mutual funds. And because of that, even if the fund had a loss that year in terms of performance, there could still be a capital gains hit for the client, which is one of the reasons why that ETF has the ETF wrapper in general has picked up steam as a more tax efficient way to invest. Doesn't matter if you're in an IRA, however, since the mutual funds owned in IRAs don't pay out capital gains as they're sold or redeemed. Those only happen on distributions out of the account themselves when you take distributions. So a little different nugget there in terms of mutual funds versus ETFs and what accounts are best to hold each.
Yeah, I think it's clear this is a topic that the three of us could nerd out on for quite a while. But in the essence
Cut
of
us
time,
off. All right, Tucker. Good decision.
Yep, I like it.
no, I think that was very helpful. Thank you guys for the descriptions, and we'll schedule a time for our deeper dive of 5 hours of ETFs or mutual.
Sounds good. Thank you,
All right,
gentlemen. Appreciate the
thanks,
time.
guys.
Thanks, Tucker.